Hi, stock investors. JJ here. Welcome back. Well, busy news day today with the market sell-off, and now we're going to catch up with Professor Jeremy Siegel from Wharton. What does he think the Fed should do? He has said that the Fed should cut rates earlier, and now there's a sell-off. What's he going to say? I think he's going to say that they should cut immediately. Let's get into it.
Joining us now is Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Jeremy, I hate, you probably aren't happy to say I told you so either, given what we're witnessing. But you thought the Fed was staying at, once again, for the second time, staying at the party too long and too restrictive.
Absolutely. And, this may surprise me. I'm calling for 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut indicated for next month at the September meeting.
Wow, he's calling for big rate cuts there, sudden. That would definitely shock the market. You'd think if that was happening. He thought that the Fed, that they raised too late, and now they're cutting too late as well. He's not the only one. Bill Ackman's been saying that. Here is a tweet from Bill Ackman. The Federal Reserve was too slow to raise rates. Now it is too slow to lower them. Bill Ackman, if you don't know, is a significant super investor, really. He's done very well, not doing well this year, but he's very vocal and divisive kind of character. He's turning out to be. But let's get back to Jeremy Siegel. Big cuts, he's saying immediately, emergency cuts.
And that's minimum. The Fed funds rate right now should be somewhere between, 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as
that is what sent the market down. If you don't know, a higher unemployment rate kind of was shocking, and that did immediately send the market down. And then Japan market went down, and it sort of escalated a number of things. War worries, you could say, who knows why, but there's a lot of things going on this week in particular.
Inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the two targets explicitly mentioned by the Federal Reserve. All right, and how much have we moved the Fed funds rate? 0.
Good point.
That makes absolutely no sense whatsoever.
So he's saying the Fed waited too long again, waited too long when inflation was taking off, and now is waiting too long. He said that they've achieved their target. Why are they waiting? Because there is a lag.
If we... Jeremy, there's no way we're getting 75 and then another 75. If we do, I don't want to see what's happening in the stock market if the Fed is compelled to do 75 twice. So it's not going to happen. But you're saying that they should. What do you really think will happen? You think they'll do an intermeeting?
They're not going to do 75. Listen, I remember 2000 when Greenspan did 50. And by the way, the market wasn't scared. The market rallied sharply. It was the same thing. December, they should have cut. They didn't cut, and the market said, you should have. And they did an emergency cut a few weeks later. The market made a strong rally from that position.
Okay, so he's seen a lot. That was back in the dot-com bubble, way back in 2000, when the market was moving sharply down after that massive run-up. So he's saying the market wouldn't be scared by a rate cut of that size. Well, who knows?
Listen, Joe, don't think that the Fed knows something like, we're afraid the Fed knows something. Since when has the
we don't
Fed
need to worry
known
about
anything
that.
about the economy?
We don't need we don't need to worry about anyone thinking that the Fed.
He's really worked up here, isn't he? He's really worked up about this.
No, not at all. I mean, look what happened 3 years ago.
No,
I mean, the market knows so much better than the Fed. So, I mean, they've got to respond. Listen, their own stated normal Fed funds rate when we hit targets is 2.8. They're basically at the target. And there's a lag in monetary policy.
Okay, so Jeremy, let's say they do that.
Taylor rule. Take a look.
He's talking about the lag when they move rates. It takes a long time for anything to happen. So that's why I think he's saying that they should have acted earlier, because there is a lag. What's going to happen even if they cut, the market will react. But what about the economy?
Look at any of the rules right now. They're all 150 basis points lower.
Let's say that Jay Powell came out and before September, an emergency meeting comes out and he lowers the rate. Does the market rip, or does the market say, oh, my goodness, it's worse than we even thought?
It rips. It welcomes it. Absolutely. Because it's so far behind the curve right now. The Fed is up in the
But that's why I'm saying maybe it doesn't rip. Maybe people say, oh, goodness. If they're willing to make an emergency cut today.
Very hard to predict. He seems sure that the market would rip if they cut rates, rather than saying, oh, no, they've got it so wrong, and go down further.
Boy, there's got to be something around the corner.
It's not going to happen today, necessarily.
Not today. I'm saying in the next couple weeks.
I mean, it could happen, and I think it should. I think they should say, listen, we're taking a look at listen, you take a look at the data. It is not at all comforting. I mean, the hiring employment part of the ISM that we got was just absolutely horrible. I mean, forget about the Psalm rules and all that are true, that are predicting recession. I'm looking at the Fed's own data and the Fed's own written policy, 2.8 when we are at and near the target. They overblew one target and they're 90% towards the other target. Period.
Okay, he's really pounding the table here for a rate cut immediately. Will they do that? He is really worked up, isn't he? Really excited about this.
Jeremy, there's no reason to think, given how long it took to move off of zero, there's no reason to think that they're going to take your advice on this. Maybe they do, but maybe not. What if they don't? Then the S&P right now is only down 6% from the highs. The Dow's only down 4%. Nasdaq's down 10.
13.
I mean, what do you how do you
13? Nasdaq's down 13 now to today. This was recorded earlier.
think the market will react if it doesn't look like the Fed's going to do anything before September?
I think the market will react badly, very honestly. I mean, if they're going to be as slow on the way down as they were on the way up, which, by the way, was the worst policy error in 50 years, then we're not in for a good time with this economy. And the Fed has to recognize. I mean, I'm just restating their own written policy. 2.8 normal Fed funds. They haven't moved 1 basis point. They're nearly twice what their normal Fed funds is.
Wow. So he's really excited about that, wasn't he? Super excited. He wants the Fed to move fast. He thinks it's important, imperative. Very passionate about that. What do you think? Do you think the Fed should move now? And how do you think the market would react to them cutting a 75 basis points? Would they even do that? They seem to think that he wouldn't, and they're going to be too slow. It's going to be interesting times here, already interesting times with the market selling off, ending up selling off very quickly, exacerbated by different things. Japan selling off. War seemed to be war worries as well. Many things going on. What do you think? Let me know in the comments, and leave us a like here if you get value out of that too, and subscribe here. Now, I also want to tell you about this offer here that I've got from ShareSite, which is a portfolio tracking and reporting tool that takes the hassle out of your investments. Certainly taking the hassle out of mine. I wouldn't recommend it if I didn't use it myself. It brings different different assets into the one portfolio, so you can track it and see how your portfolio is doing. And it's especially good at times like this when things are plummeting, just to see what's going on in your portfolio, assess things. And if you've got different brokers, it brings it all in and you can see it. There's a special offer here. Go and see it to the landing page. I'll put a link in the description to that. You can also sign up for free but get the premium features for the special offer. I can't promise that that'll be there for that long, so go and check that out now. And there's a video here if you want to see what it's all about. So I'm going to put a link on screen now to what YouTube thinks that you should watch next, by the way, as well. And a subscribe link. This is a new channel. I'm reacting to news every day, and the fast and furious news at the moment with the market going nuts and Jeremy Siegel getting really excited there. So thanks for your company on this one, and I'll see you in the next one.